many of you know, studied Bismarckian policy, but he was quite concerned about Marx and Engels and all these folks that were talking about the revolution of the proletariat. And he came to the conclusion that if in Germany, in those days, they didn't socialize a good deal of the risk, that conservatives might find themselves not only out of office and out of power, but maybe in jail or worse. And so Germany back then adopted, unless my history is off, a very broad program of what they called social insurance. They didn't call it entitlements, a word I can't stand. And so beginning back then, Germany insured a great deal of this, that is, spread the risk in a societal sense. When it came to old age, health, injuries in the workplace, disability generally, and I think I'm correct in saying that that system in Germany continues. And in point of fact, when the Iron Curtain came down, what we called West Germany proceeded to spend an awful lot of money and raise its taxes to make it possible for folks in East Germany to have that same kind of system. A little guidance from policymakers, folks. Nonnie, why don't we start with you? I mean, okay, so there are these risks out there, and we think that individuals should be expected to sink or swim on their own. What would you say to this governor or another governor, the President of the United States, and members of Congress about this? What are the guidelines here? What are the...
Well, I actually think, is this thing on? I can't tell. Can you hear? I actually think that, I mean, there's sort of a small answer, which would be, you know, you have to look at each risk and decide, you know, how you're going to handle each risk and all of that. But I think the broader answer is that it's got to be society. It's got to be committed to a sense of social responsibility, or you have to have a leader that will get society to agree to that so that you can have a broad scheme like what Germany had and has, and in fact we had for a long time, and it has been chipped away at, undercut, sort of changed because we as a society have less interest in protecting our friends, neighbors, colleagues, other people who live in the community than we used to be. It's in part I think the United States push to individualism, but without some leadership to say, this, even if it is sort of an Ayn Randian kind of an argument, this could happen to you, and so therefore you should support helping other people because you'll get helped in the end. It's not something that we as a society are willing to buy now. I think so I think you really do, if you're the governor, you have to kind of pick the places where you can push on getting society to share the risk, like the Massachusetts health insurance mandate, which took a huge amount of political capital on a lot of people's parts to make that happen, to say this is better for everybody, including you, whoever you are, because you will also get coverage.
Jim, what do you think?
I'm not optimistic that I can give a generalized answer. I think what Nonnie said first is unfortunately what we're stuck with, which is that you have to keep looking at each of these situations, and you have to look at the degree to which the private sector then reacts, and the government needs then to take a slightly different course, and that all of these things become constantly under change, that they cannot stay the same, or they will get taken advantage of, they will get captured, they will produce unintended consequences. And so I think you have to sort of start with saying there are things that we're required to do out of compassion in in society, and those things we must do. But there's always dangers in setting up government programs to handle those things, and you're going to have to keep adjusting them all the time.
You know, I would add one thing, Mike. I think that one of the things that has happened to us in the U.S. is this degradation of the appreciation for the role of government. And that Jim mentioned that, you know, that there is a view that you shouldn't have government do these things because they're no good at it. And then he gave the example of the Social Security Administration that has expenses of 1%. We actually do a very good job at it, but the generalized notion is that government isn't any good at it, and we shouldn't let them manage the risk. Let it manage the risk.
And we're not alone, right? I mean, Europe is struggling these days. Jim, what? I mean, they have a tradition, I think, of socializing risk a lot more than we do. So why are they in such big trouble? And it's not just Greece that we're talking about.
Yeah. I don't know that I can tie what has happened in Europe to socialization of risk in any sense. I think that some of the countries obviously have taken what I think is the easy way out of negotiations with their public employees and said, we're not going to pay you more now, but we'll pay you 3 times as much as you asked for if you wait until we're out of power and the next group is in. And that comes back to bite you. But I also think that Europe, as I said earlier, as well as the United States, has put itself in this terribly vulnerable position by allowing oversized and over-leveraged banks that then have to be protected when they make foolish loans.
Okay, let's go out to the audience and have a discussion. So, who wants to talk about it? Yeah.
Thank you. So as I listen to you, 2 questions come into my mind. One is, at what point do we stop the process of socializing risk? What are the limits of socializing risk? At what point do we say people should be incurring the loss themselves, or we should be relying on charitable organizations to deal with people who don't have the funds to deal with their own risk consequences? And the second question is, how do we quantify the opportunity costs of forcing people to buy various forms of insurance, either directly or through taxation? So as an example of the problem, supposing we have a low-income family that is being forced to buy homeowners insurance, health insurance, other kinds of insurance, who say, if we had our brothers, we'd prefer not to buy any of this. We would prefer to spend money on a college education for our children. So we're taking away the right of people to make that kind of choice. And there must be an opportunity cost associated with that. How do we quantify the cost of forcing people to make these purchases?
So I think I lost your first question in the beginning, but the second part of that was the lost opportunity cost. I'm not sure that's the way to look at it. Yes, there are lots of people, and I have friends who have said, I don't think government should make me buy auto insurance. I can pay for any damage that I cause, or I don't think that I should have to buy health insurance because actually in the healthcare connector, I sat on the board here in Massachusetts, and we were trying to come up with plans that would cover everybody appropriately, and we called the young people, and mostly the young men, the young invincibles, because they thought they were never gonna need health insurance until they got in a motorcycle accident or something. So I think you have to think, is it the individual's freedom that you are impinging on. Or is it society's responsibility? If that kid gets in a motorcycle accident, we are all gonna end up paying for that anyway. And that individual won't have been at all responsible for taking care of himself. But I think you have to, it is the balance between individual responsibility and social responsibility. Your example of the poor family that says, well, we'd like to save for the college education, which is a very reasonable thing to want to do. Somebody in that family gets sick, they first spend that money that they've saved, and then we're all going to pay for the illness. So the idea of insurance is to anticipate the kind of risks that you may reasonably be confronting, and you don't have to pay as much for that as if you were just paying the bills at the hospital, because you've spread the risk. But it does mean that you can't use that money for something else, and it's really it's a values decision in that way. I don't know.
I don't think I have anything to add to Nonnie's answer.
Okay, who's next? Yeah.
Hi, my name is Kristen. I'm a student here in Houston. I had a question with the example that you used of the young invincible in the motorcycle accident. Just from a personal experience, I have a friend that contracted food poisoning while on the boat. His brother was.
Not
Well,
here,
what?
not here, I hope.
I have a friend that contracted food poisoning and actually accrued some pretty hefty bills. He's a chef. He didn't have any insurance. He put the bill on his credit card, which then screwed him up for many, many, many years. Had he not done that, when you say we all pay for things, is that really the case? I mean, would this individual have been, he would have been better off to say, I can't afford X, Y, or Z, but he put it on his credit card. I guess, what are the conditions that would make somebody not have to pay for their injury or illness that they contracted, because not everybody could afford, you know, I mean, he had a job, but he couldn't afford a $35,000 hospital bill.
Right, but he did have a credit card, so he was in fact able to pay for it. But if his expenses had been more, and he probably, I would expect, got care before he paid for it, because he didn't have insurance. But he certainly was put in a, I mean, you've just made the argument for mandatory health insurance and for national, you know, here in Massachusetts, but also national health insurance, so that people's lives are not destroyed by these catastrophic illnesses. That is actually, the bankruptcy experts will tell you that the individuals who file for bankruptcy don't do so because they've got, you know, they bought an expensive car and couldn't pay for it. That in general, it's because they've either lost a job or had a catastrophic illness.
Who's next?
Hi. Do you have an opinion as to Dodd-Frank and whether or not we're going to see any, effective response to? I don't really understand it that well, and I haven't been encouraged by what I hear in the news. And
Sorry, I missed that. I don't know that.
Oh.
Do we have an opinion about what?
Dodd-Frank.
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 The legislation that came out of the financial crisis.
Oh, Dodd-Frank.
Yeah.
Yeah. Okay, I'll go first on that one, if I may, and say, before I give my opinion, I'm going to quote a congressman who I ran into just when it passed, who said to me, Jim, I know you're a former teacher and you're going to grade this bill that's coming out of Congress and you're going to give it a B-, just want you to know that B- is the best grade Congress has earned in 50 years in financial literacy. And so, I don't know exactly what grade I give it, but it's not an A. The problem is that the banks are way too large, the top banks are. They are way too leveraged. They're able to leverage themselves nominally 30 or 40 to 1. And
Jim, explain to people what leverage means.
I will take a crack at it. They're able to have assets, they're able to have positions in things that they invest in that may go up or down, that are many times their capital or their actual ability to pay the losses. And so you are leveraged if you want to buy stock and you want to buy $10,000 worth of stock and you borrow 5,000 of it, then you're leveraged. And that's effectively what the banks do, but they're not doing it 1-to-1 as 5,000 to 5,000 to 10,000. They're doing it 30 to 1 or 40 to 1 nominally. And if you actually take this in a very technical accounting way and sort of sort out what the real leverage is, it's much higher than that. And so that means that
In other words, they're exposed
they are
to
exposed.
risk far in excess of what they happen to have.
They are exposed to 50 times or more what their capital would allow. That means that you get natural cycles of an economy, and it's not sustainable for them, and then we pay for them. So 9 out of 10 years, they do fine, everybody takes home big bonuses, and in the 10th year, things go bad, they lose all the money because of this very high leverage, and then we pay, and then you start over. And Dodd-Frank did very little about that. It's not that some of the leaders weren't trying, but the votes weren't there, the will wasn't there, the lessons weren't well understood either in the Congress or in the public, and so it didn't get fixed.
And the banks were pushing against it.
Pushing very hard against it.
I guess I might just sort of add on to that, which I think if you look back in history from after the Great Depression, I don't know what we're going to call this, but it took a long time actually for legislation to be passed that really controlled, at least in the securities area, because there was the Securities Act of 1933, then there was the Securities Act of 1934, there was one from 1940. It takes a while to really get people to understand that we need to develop legislation to understand what happened and why did it happen. And I think we're getting a lot of help in this understanding, actually, certainly from Britain, where their central bankers are being much more strict about the control of their banks, requiring more capital, so to protect against this over-leveraging. And little bitty Iceland, who everybody laughed at, has really stepped up to the plate and taken, those bankers are gonna go to jail. And they have taken control of their banks. They have taken control of their banks, and I was actually in Iceland this summer, and I was told that they will pay back, the banks will pay back, not the taxpayers, all of the money that the banks lost for the pensioners in England and the borrowers in Scotland and wherever they were.
The only thing I want to add to that is that unfortunately the United States is opposed to raising capital requirements on banks and trying to convince Europe not to do some of the things that Nonnie and I approve of.
Why are they doing that, Jim?
The policy of the United States seems to be at the moment that if we don't have healthy, profitable, vigorous banks, the economy can't recover. They have to be healthy first. And so they don't want to do anything that constrains their profits in any way. I think it's a wrong argument, but that seems to be the argument.
Interestingly enough, folks, Massachusetts, you know, does regulate state banks. We have 145 of them. They're all fine. They're all doing just fine. These are the so-called community banks. They have a headquarters bank and maybe 7 or 8 branches in the general area, and they're all doing great. But we regulate the hell out of them. Subprime mortgages.
The business is lending, which is not the business of the large banks anymore.
What's the business of the large banks?
Well, the business of the large banks has been selling derivatives and then hedging those in a way that increases risk further.
And hedging means what?
Hedging, you know, it's one of those things. I'll give you the definition of what it means, but it's not really what they do. There's the word and then there's the action, and they don't overlap. Hedging means taking the opposite side of a transaction you've just taken in order to protect yourself if the market moves against you. But what they really do is they'll take one side of a transaction and then approximately take the other side, but isn't quite. And the not quite turns out to be the thing that moves them billions of dollars at a time, because the amounts of these hedges are in trillions, or tens of trillions now.
Yeah, go ahead. Yeah, got it. Where's the microphone? What happened to the microphone? Oh, you have it. Okay. Sorry, we'll come back then. Yeah.
And sort of a follow-up to all of this. I know my experience, you know, I've been around a while. Banks go from one extreme to another. Either they're going to they will loan you more money than you could possibly want, or they wouldn't give you money unless you absolutely didn't need it. And now, of course, we're in a state right now where the banks will only give you money if you don't need it, because I know they're blowing out at 4% on 30 years, which is historically very low. But what I want to know is if the government is going to insure the bank mortgages, you have to go through all kinds of paperwork to get your mortgage. Why is it that they don't check that the most important thing that they should be checking is to see if the person has the capacity to be able to repay the mortgage? And you say if the person can't establish the capacity to repay the mortgage, it will not be insured. Is this? Do you think this is the way that we should be operating?
Okay. I'll take first crack and say, I don't think the government should be insuring mortgages. As I told you, I think that Fannie Mae and Freddie Mac have been a disaster. They have not increased the percentage of home ownership over what we had when you had to go to a community bank and get a mortgage and they had to take the risk. And so the whole purpose of it was for more people to be able to own homes, but more people don't own homes. The percentage is the same. And it hasn't grown at all. In fact, it's shrunk a little. And the cost, I think, I happen to bring this number with me, of what Fannie Mae and Freddie Mac are going to cost us in bailout is now a cost to the taxpayer until today of $124 billion, but today they announced that actually that's wrong and it's going to be at least $8 billion higher.
Jim, tell us a little bit about the history of this, will you? I mean, we hear about Freddie Mac and Fannie Mae and what a mess it is. How did we get into this? Why did we get into it? And what was the point of all this?
As I said earlier, the point, it was all well-intentioned in the beginning. I'm not sure it is now, but it was then all well-intentioned that we thought as a matter of public policy, the country thought that it was good for the country for a higher percentage of people to own homes, that people behaved more responsibly, they had a better sense of being part of the society and the system, and that families would be more stable. There were a lot of reasons why everybody believed that it would be good for a higher percentage of people to own homes. But the mechanism they came up with did not produce that result. It did produce extremely high profits for executives, bonuses for executives at Fannie Mae and Freddie Mac, and it produced for the taxpayers this now $132 billion loss.
And how does this work? I mean, how did it work? How has it been, I mean, tell us how this, what happens here? I want a mortgage. I go to a bank. They give it to me.
Yeah, the bank gives you the mortgage, and then the bank manages to effectively, it's actually done through the insurance program, but effectively, it transfers the mortgage to one of these quasi-government, they're private, but they're effectively, well, now they're in receivership, not clear whether private.
What percentage of all of these home mortgages only?
I think so.
I think so. And what percentage of all of the home mortgages we have in this country, in effect, have been turned over to Fannie Mae and Freddie Mac? Any idea? It's more than half, isn't it?
It is many,
Oh,
it's much more than half.
Much more than half.
Yeah, we're struggling with whether it's 85 or 90 or 95.
It's
a number
like that.
So
But-
most mortgage lenders have used this as a way to essentially pass the risk on to these quasi.
They'll pass the
Public
risk on
entity.
to us, as it turns out.
Yeah.
But this is a perfect example of moral hazard, really, because the bankers no longer have any risk associated with that mortgage. Once they've given the mortgage to the homeowner, then they essentially have fobbed it off on Fannie Mae and Freddie Mac. They have nothing invested in whether that mortgage performs or not. So they're no longer involved in trying to control the risk. And they're making lots of money doing this too. So this is the problem of privatizing the profit and socializing the risk. That the bankers are getting the benefit from this, and we're all paying for it because we haven't structured the incentives in the right way.
Okay, so take us one step further and explain to us what I gather is the next step, which is this derivative stuff.
That was gonna be Jim's.
Yeah, I mean, Fannie Mae and Freddie Mac have presumably, what, guaranteed these mortgages? Okay, so take us, what is this securitization stuff? I don't know about you folks, but
I don't understand it.
I'm still trying to figure this out. So what happens then?
Well, actually, it's.
Because I assume these mortgages, before they're securitized, have been insured by Fannie Mae and Freddie Mac, right?
Fannie Mae and Freddie Mac effectively hold them.
Okay.
At that point, what they've done is they then package a whole bunch of them.
Who does?
Fannie and Freddie.
Okay.
And so they put together a whole bunch of mortgages, a very large number of them, and they will sell a participation in that as though it were a little corporation of its own. It's a big package of mortgages, and you can buy your 1,000th or 1,000,000th of a percent of that package of mortgages. And one of the weird things that happened, just following up on what Nonnie said, is that the banks managed to get out of the risk of individual mortgages by passing them on to Fannie and Freddie, but then bought them back in packages. That's the worst of all outcomes, because then they had no incentive when they originated the loan to monitor the risk or control the risk, so they went way overboard and originated as many as they could. But then they bought them back, so if they went down, they actually did end up paying it. But they didn't end up paying it on the individual basis that would have overcome the moral hazard, where they would have underwritten and they would have been careful about who they gave it to. So they did end up paying for them in some way, and that's what we bailed them out for, was these packages of mortgages.
Which the banks themselves purchased after.
They didn't
Fannie
have
Mae and
to.
Freddie Mac.
They didn't have to, but they ended up back with them. You know,
And why did they
originate the mortgage, they sell it off to Fannie or Freddie, and then voluntarily they bought them back
Why would they do that?
because they thought that they were great investments. They were wrong. You said?
They used to be reliable, you know, a guaranteed stream of income, but when they securitized them with all the poor loans, they just plummeted.
Housing prices had gone up so many years in a row that they thought there was no risk.
John, there's somebody over there.
Who's next? Who's next? I have a lady doctor. Remember the 64, what was it, the $64,000 question? Right? He says, I have a lady doctor. Yeah, anyway, got a gentleman.
The best way to describe this is if I was a banker, you know, I take your money, which you give to me as a deposit, okay, I then invest it. And if the investment comes out good, I win. If the investment comes out bad, you lose. It's a great system. I'd like to be part of it.
But why do I lose if all I've done is to get a mortgage? Why would I lose?
So it's, this is, I think, the right way to look at it from a system point of view, which is that the bankers get the benefit of the investment that people were making in these mortgages, and then when they collapsed, the banks collapsed, the taxpayers ended up paying for the responsibility, not on an individual basis, but
Right.
as a societal basis.
One of the worst things I think that ever happened was when they let the banks and the investment houses, you know, and the retail brokers all come into one entity.
What about that?
Because that creates a tremendous amount of conflict of interest. I mean, you've got the Morgan Stanley, for example, the brokers are selling stuff that if it turns out bad, it's your loss, and if it turns out good, it's Morgan Stanley's gain. And the conflict of interest in terms of selling some of this stuff is really tremendous.
So we should not have repealed Glass-Steagall.
We should not have repealed
You
Glass-Steagall.
agree with that, Jim?
Well, yes, I agree with that. However, we needed actually to strengthen Glass-Steagall. It's not that we shouldn't have repealed it because Glass-Steagall wouldn't have cured what went wrong. They're really, think of the banking business as having 4 pieces to it. There's investment banking, there's loans, which is the traditional business, there's money management, which is the business they wanted to separate from investment banking when Glass-Steagall was passed, so that you could manage somebody's money and then put it in your public offerings that you were investment banker for. But now there's this derivatives business. That's what we were talking about. The hedging, the securitization, that sort of thing is the 4th business. And that's actually the one producing the largest share of the profits now. So Glass-Steagall should have been strengthened to forbid the same entities that were the payment mechanism from having these highly leveraged derivative positions, but instead it was repealed. So when it needed to be strengthened, it was repealed. I think we probably agree.
Yeah, we agree on that.
Who's next?
It's over there.
Taking one step further, trying to tie in the insurance and the financial and banking aspect of it, AIG was involved directly in it as well. So AIG was involved with the securitization of the banks. Can you go through that whole process? Because to me, that was everybody felt as though they were protected, and they moved up the line, and then came AIG, who didn't have the funds at that point to support everybody below us.
Well, I was following the AIG situation pretty closely because I was insurance commissioner then. And we did not, in Massachusetts, fortunately, have any AIG companies here that we were regulating, but we do have a lot of AIG policies here. So there were a lot of people we were worried about. They write about 1/3 of the workers' comp coverage in Massachusetts, and there are lots and lots of people who have life policies that are written by
Talking about AIG, just as a straight
AIG
insurer.
as an insurer.
Okay.
So the insurance commissioners were watching this very carefully. What AIG was a giant, international, global company. The piece of the business that caused the problem was the financial products division that was basically run out of London. And they were, I could go on about this for a very long time, so I won't. But the point is that when that business ran into trouble, people had supported that business thinking that AIG's balance sheet was behind it. But when the business ran into trouble, the insurance commissioners said, you cannot use the insurance companies to make up that loss. And then they first had what was a liquidity crisis because they couldn't pay on the collateral calls that were made, and then they really had a fundamental equity crisis, capital crisis, because they couldn't get at the insurance, the value of the insurance companies. But I think in addition, one of the things that happened during the period, and I'm sure Jim probably knows more about this than I do, during the period when Glass-Steagall was repealed, in addition to that, there was the, quote, Commodities Futures Trading Act Modernization Act, which said to the insurance commissioners, whatever you think these derivatives are, we thought that they were insurance, because
Talking about the state insurance commissioner.
the state, well, because insurance in the United States is regulated at the state level, we're saying and I say we, I was not insurance commissioner, that was 1990, I think. 90, is that right? They were saying this is essentially a form of insurance, and Congress passed a law that said it's not insurance. And not only that, but if you think it's gambling, because some of these things are uncollateralized, and it's just like gambling, I'm betting that your company's gonna go under. They said, and you can't regulate it at the state level as gambling. So, you know, Congress made a decision that they could play this game.
So, two
You
quick
have-
follow-up comments. I agree completely with what Nonnie just said about AIG, but I would add two things. One is that just as I feel about the banks, AIG should never have been allowed to be in the highly leveraged derivatives business. They ran this business in London, said it has nothing to do with our insurance business, but it took down the whole enterprise. And so it did have something to do with the insurance business, and they should never have been permitted to do it.
Who should have stopped them, Jim?
Well, that'll be debated forever. I was going to get to the Commodity Modernization Act, Commodity Trading Modernization Act, which made it very difficult. But there's an argument that the New York Insurance Department, not Nonnie's, but the New York Insurance Department could have been more aggressive about it.
And they
if
tried,
either of us
actually.
had been
They
commissioner,
tried.
yeah, but we would have tried harder.
Yeah, they tried.
But it would have been very difficult to do, because that act that passed Congress, and incidentally, I think some of you know I'm a Democrat, I work for a Democrat, but passed with the Democratic administration's recommendation and the Democratic Congress passing it. So, it was not entirely the Republicans' fault here. Both parties are to blame for this regulatory lapse. That act not only made it nearly impossible for insurance commissioners to do anything about highly leveraged derivatives trading, but it forbade the CFTC, which was the federal agency that was supposed to do this, from doing anything about it. And you may know the story of Brooks v. Bourne, who was my successor as chairman there, and she resigned because she was unable to do her job when Congress basically said, don't.
And the administration.
And the
I mean,
administration.
Bob Rubin, who was Secretary of the Treasury at the time, was deeply involved in this, wasn't he? Or was he Secretary?
Was.
Yes.
He was.
Yes.
Yeah.
Yes.
I think even he would agree with that.
Who's next?
I am.
Thank you.
Actually, a couple of comments. Professor Larry Leventhal came in, and he was, in a previous session, and he was talking about collectivism versus individualism, which definitely is embedded, I think, in what you both are saying. Is what's the balance between collectivism versus individualism, and that the extreme sense of individualism in the United States obviously has an effect on how we perceive policy, our moral compass, etc. And I think it's being exacerbated now with survival issues.
people who are in survival mode, it's like all bets are off, it's like cover my butt. So that's one comment that I think it does influence how we find that balance. So I'd like to hear a comment on that. And then the second question is, what would have happened had we not done the bailout?
I'll give you that one.
The other one,
I'll do the other one.
Okay.
Well, I mean, I really have been talking, I think, about this notion of finding the right balance between a collective sense of collective responsibility and individual responsibility, and not doing it in a kind of rhetorical way, but really trying to analyze the risks that are being addressed and to see whether you can get the incentives in the right places depending on who's got control over the loss or the cost of the loss. And so, but you have to get people who are willing to actually enter into that conversation in order to figure out where the right balance is. But it's, the rhetoric now is so hot and so extreme that it's really hard to have a conversation at that level where you can talk about it in a responsible way.
Well, but I'm not sure that, the question is, can you truly, realistically have that type of conversation in a very individualistic oriented society?
Well, some of this is leadership, right? I mean, you have to, Mike, somebody asked, I think it was you, how did the U.S. get in this position of allowing the banks to be so powerful? Something, you know, why are we unwilling to manage the banks? And there is a economist named Simon Johnson, who was the chief economist for the International Monetary Fund and now is a professor at MIT, and he refers to the bankers as the oligarchs, that they have taken over not only the economy, but they've taken over the psyche of Congress at least, and I would say, and the public too, that this notion of the, quote, free market, which is really nonsense because, I mean, they've all gotten bailed out, they all got, they all have access to the Federal Reserve's discount window where these guys are borrowing money at 1% and loaning it at 6%. They are being supported by the government, but they have taken over the philosophical thinking of all of us and said, you know, free market, let the free market do.
You think that's changing? I mean, it's the I've been surprised, Nonnie, at how this Occupy movement has connected and sustained itself when it was just a bunch of kids in tents. Does that reflect, and now they seem to be getting more support from other folks and the thing seems to be growing and all this kind of stuff. Does that reflect a change in public opinion about all of this? Are people beginning to be much more skeptical of this kind of free market stuff as it applies to the big banks? What do you think?
I think it is. I think people are hurting all over the United States, and the story that just leave the banks alone and everything will be fine, they know didn't work. And so I think this conversation is getting some traction, I would say.
Jim?
Well, let me answer the other question, which is what would happen if we hadn't done the bailouts? So my view of that is that we had to do the bailouts, that we were held hostage, the economy really would have been damaged. It was damaged tremendously. It would have been damaged much worse if there had not been the bailouts. So I probably would have supported, if I'd been in a policy position, doing the bailouts, but with a huge but. The bailouts could have been conditioned on saying, you're not going to be in the derivatives business anymore. You're not going to be, the 10 largest banks are not going to have a 50% market share. You're going to have a 10% market share. You're going to split up at least 5 ways, each of you. And we could have done all of those things at the time of the bailout. Instead, we didn't. It wasn't conditioned essentially on anything. And once the banks were bailed out, their tremendous lobbying power was very effective in making it hard for there to be reforms after that.
And in
Which is
fact,
why
mergers were encouraged, were they not?
Well, yes,
To some extent.
more
Acquisitions.
concentration as a result, more concentration as a result of the crisis. That's right.
So why did we not attach conditions? Why did the administration not attach conditions to them?
I honestly cannot tell you the answer to that. I have thought about that and thought about that. I guess they were talked out of it by either what they thought were on the merits arguments or political arguments. But I think they're terribly wrong, so I can't give you their side of the argument. You'd have to ask somebody else.
And of course, the folks who were making the decisions at that time were part of the industry, weren't they? Really?
Yes.
I mean, they were being,
Yeah.
they came into the government, but they were essentially folks that had been part of the system.
You know, the last 4 secretaries of the Treasury, 3 of the last 4 until Geithner came from Goldman Sachs.
My candidate for Secretary of the Treasury would have been my pal Stone. I think it'd have been a terrific Secretary of the Treasury. Where's the microphone? Yeah. Who's that, Steve?
Hi, Steve Higgins. Yeah, I think, well, one thing on it, I like the expression socialized risk, although I think I might get less there about you, thanks. But I do think that there is a kind of, if you like, individualist or libertarian thought that that risk shouldn't be socialized, because what that really means is some people subsidizing others, right? So it's not just being forced to buy insurance for yourself, it's being forced to buy insurance for other people, and we have a very powerful reaction against that. So I don't think we should take for granted the idea that these kinds of things will survive with public support. But I'm wondering, I mean, so Nonnie, you started off with the hurricane, and we're thinking about individuals, for the most part, subject to disasters that are totally out of their control. Somehow we've ended up with the banks and these investment people and so on. And I feel like these are not really the same kind of animal, and that somehow we should be able to find, or maybe we have to try to find, a distinction between the original impetus to socialize risks for individuals, protect them from things that they couldn't protect themselves from, versus now, in effect, protecting institutions that, so to speak, well, they claim to exist in the free market, taking risks in order to make profits, and then when they fail, we ended up supporting them. So I wonder if there's, I mean, I don't like the sort of pure case-by-case basis, because I think that's how we've gotten maybe into this mess or confused student activities. But, you know, could we say that we want to, or it's a good thing to socialize risks for individuals against natural disasters, health accidents, and so, you know, things of this sort, that that's a noble and a good thing to do. But that we shouldn't be socializing risks for profit-making companies, because then we are, by definition, in the business of privatizing profits and socializing risks. So, I mean, is there a way to draw that distinction between individuals and institutions or businesses?
You're not getting any argument from me on that one. I think the reason that it is important, though, to talk about why we shouldn't socialize the risk for these big financial institutions is because it does damage to individuals and society. That we have, that in all this sort of analysis about whether we buy insurance, don't buy insurance, all that, we forget about the overarching public good here that we are damaging seriously by socializing the risk of these big institutions who should have been able to manage it themselves. I do agree with Jim that once we got faced with these monster banks and a financial collapse that probably would have been a lot worse if we let them fail, that we probably didn't have a choice. But we need to reel back and say we're not going to do that anymore, I think.
So, stated the way you stated the question, I'm going to agree with you. Obviously, you don't want to have a socialization of profit-making enterprises so that they can make more profit. That's not what this is about. But I do think that the notion that we can come up with a simple principle is wrong. Because take a look at, you say, yeah, we should do health insurance, but we shouldn't do banking. But we really had to do the FDIC because that was protecting depositors. Well, then, as I said, the Fannie and Freddie guaranteeing the mortgages. That was so more Americans could own homes, something that actually came from the liberal end of the political spectrum, but was sold to both sides and became a consensus view. And it was well-intentioned. It turned out to be wrong. So a lot of this, I think, really is not easily soluble by establishing a simple principle.
Just a question on FDIC. So if the bank collapsed and the individuals got their deposits returned, the bank would still collapse. Isn't that right?
Well, maybe. But if a bank is about to collapse and everybody knows that you have FDIC insurance, so you don't have to pull your money out in a hurry, then the bank doesn't collapse. So now you've subsidized the shareholders and the executives of the bank. There's no way around this. There are no bright lines here. That's why I say these problems don't have bright lines, simple philosophical answers. You need to keep adjusting. But when you find that you're doing what you said you don't like, well, that's when you stop and say, now we've gone too far and we ought not to be subsidizing something for the benefit only of those who make profit rather than for the benefit of the public.
And remember too, Steve, that at least at the state level, regulators have the right, and in fact often do, close that bank down, turn its deposits over to some other bank, and that's the end of the bank. I mean, we used to do that over a weekend. I mean, the ex 5-cent savings bank disappeared, and all of a sudden it was another bank. I mean, and we had that authority. So it wasn't as if the fact that deposits were insured meant that they just have a wonderful time continuing to make money. I mean, if they get into trouble, bingo. That was just, and the federal government has that authority as well with federal banks. And in fact, who was the?
Sheila Bair.
Sheila Bair did that frequently when a bank got into trouble. So that's a part of the regulatory system that doesn't require us to continue to put up with these people if in point of fact they have screwed up royally. And both the state and federal government.
But Steve, I would say that rather than trying to get to a grand principle like that, that you should look at each of these attempts to manage risk and think about what are the incentives here of who can control the risk to begin with, and again, who can control the scope of the loss, and put the responsibility for controlling the risk on the person who can control it and the person who can control the scope of the loss on that. And so instead of trying to do it from the point of view of what does the institution look like. I mean, they're all run by people, right? So you've got to figure out what drives them and what is the structure. So if you're looking at encouraging home ownership, first of all, I think we should have looked at this all along the way, not, is home ownership growing under this system? Instead of just launching it off and keeping it going and then discovering 50 years later that it's not working.
Who's next?
Me. But could you make the argument that if you were going to socialize risk, private risk, that it would be justifiable to very progressively tax the profits that accrue. That is to say, I mean, you could make the argument that the private sector might be better or equally good at creating capital. But if you did, presumably, and if that capital was created through the socialization of risk, through, for example, the questionable issuance of credit default swaps, based upon fraudulently given subprime credit ratings, that those profits should be taxed at like 80 or 90%. And following Bismarck's pattern, transferred back into the hands of consumers who are unable to find remotely adequately paying jobs.
So, years ago, maybe 1984 or something like that, Warren Buffett wrote an op-ed piece for the Washington Post in which he suggested that profits on financial transactions held less than a year be taxed at 95% or some number like that. And what he was getting at is in some ways similar to what you were saying. It's hard to do exactly what you said, but a transactions tax would accomplish a lot of that in the financial sector. Your statement could apply to any sector. I've thought mostly about the financial sector.
What's a transaction tax?
Yeah, I would favor a tax that said every time you buy or sell, you pay a little bit.
Buy or sell what?
Any financial asset, stocks, bonds, derivatives, whatever it may be, you pay a little bit, which means that if you're going to be in this business of trading stuff all the time that creates these trillions of dollars in transaction amounts, you're going to pay quite a lot into the system, and that'll make up for some of the damage that you do by creating systemic risk.
Would you use the proceeds from that tax for any specific purpose, or would it be just general revenue?
That's not really a question that I have a strong view on. I think that we could use some general revenue right now. And there's no specific purpose that I'd name. You get a lot of money that way.
Well, the transaction tax was proposed in Dodd-Frank. There's a transaction tax that's, at least out there under discussion now. It's going nowhere.
Right.
Nowhere.
Right. Yep.
Who's next? Okay, go ahead.
It seems to me that when Nonnie was talking about how society has tended to backing away from socialized risk, and the oligarchs have a larger share of mind, that a lot of this comes down to communication. And in simplistic terms, it seems to me when FDR, the great communicator, when he was president, that a lot of these regulations were put in place, and the slide downward started with Reagan, where he was convincing people the government had to be smaller. And so what I'm wondering is, do you have any thoughts about when did the Democrats and the left start losing their ability to communicate in a clear and simple manner that could capture people's concepts of what actually is going on?
I'm not sure I can handle that one, but I mean, you've got the timing kind of right. And if you look at, there are all sorts of charts out there to look at the amount of regulation and the reduction in regulation under Reagan. It's kind of engrossed, so that it's not very refined in a way that you can really look at it. But in terms of the banking regulation, you can hit these highlights that my sense is that it was really a result of a very, very concentrated and long effort on the part of people in the banking and financial sector to change people's minds about this.
Yeah, let me just add that I really think that both parties are about equally responsible here with respect to specific government actions. You could say that philosophically the shift occurred under Reagan, but the laws that actually changed mostly in the 90s and not under Reagan. So the law that allowed banks to branch all over the country, then Gramm-Leach-Bliley, then this Commodity Futures Modernization Act, these were laws that occurred with Democratic support. So both parties have been caught up in this false notion.
I mean, even at the state level, when it came to health costs, some of you will recall that as long as, and it wasn't, I inherited this from a previous Republican administration, we treated hospitals as public utilities in this state. They couldn't raise their rates a nickel without getting the approval of something called the State Rate Setting Commission, which was kind of the health equivalent of the Public Utilities Commission. And then I left office, Weld was elected, but there was an overwhelmingly Democratic legislature, and we were into this deregulation stuff. And so the Rate Setting Commission effectively wasn't totally abolished, but it was emasculated, and we decided we were going to deregulate health costs. Welcome to the wonderful world of deregulated health costs. And there's only one state in the country that still regulates hospital costs, and that's the state of Maryland, whose hospital costs are substantially lower than ours. And Hopkins is not a particularly shabby healthcare institution. So I think, I agree with Jim. I mean, I think we were all caught up in this thing. And even the late, great Senator Kennedy and Steve Breyer, his principal staff guy, decided that we ought to deregulate the airlines, right? And we've lived happily ever after, right? Well, there you are. So it was quite bipartisan. And was it, you know, who convinced us of all of this? I don't know. Memories are short, folks. You know? We got a bunch of folks in the Congress these days, good luck to them, who are basically back to the Herbert Hoover School of Economics. I say that seriously, I'm not kidding. The way to come out of recession is austerity. That make a lot of sense to me. It's not working for Greece, among other places. Who's next? Yeah.
I keep going back to our initial question of how much should government socialize risk, and I'm wondering which risks should be socialized, and I would be willing to guess that most Americans don't feel that there is a consensus on which risks should be socialized. I think that's the Stephan's question about the family that is thinking, I don't want to buy automobile insurance, I want to put aside money for a college education. Well, you know, why do we subsidize automobile insurance? Why do we socialize the risk of car insurance, but we don't socialize the risk of a poor education? You know, how is that?
That's a good one.
How is that? How do we make these decisions about what risks we are going to socialize? I think the public probably feels that that's being dictated.
Well, you're all voters, I think, or you should be. I mean, actually, I don't mean to be specious about it. This is a very important public discussion, and the laws get passed by our legislatures, whether it's at the state level or the federal level. And if you want to, anybody wants to be a part of that conversation about what risks should be socialized and to what degree, everybody needs to participate. But it is a part of the national conversation of how should we make these decisions and what should we do. There are people, I mean, I think Mike started out saying that, or maybe it's Jim, that we generally agree that we would support people to make sure that they're not sleeping on the streets. I don't, you know, I think if you put it that way, everybody would agree, but if you ask them, should we have, some sort of income maintenance for people, I'm not sure people would agree on that.
Well, but I want to emphasize what I really led off with when I talked, which is that the whole process of deciding what a government should do involves risk and socialization of cost and that sort of thing. So, you know, there are things you take for granted, but it wasn't always the case. You go back to the time of the Revolutionary War, and there was no fire department. They didn't come and put out the fire. You paid privately to belong to an association which would agree to put out a fire if your house had their mark on it. And otherwise they didn't. And so it was decided somewhere along the way that that was a risk in these terms that you want to socialize. I don't like that term, but still, that's what happened. And so the ultimate version of that is to tax and provide the service. So everything else is just a lesser version of that same thing. But that's what we do in fire, that's what we do in police. You could argue that you know, people who don't own any goods don't need the same protection as people who own goods from armed robbers. But we socialize it. We decide that everybody's going to get protection from armed robbers, so we tax and run a police force. We do this stuff all the time in a government, even in a government that's not a democracy. But in a government that is, you get to debate it all the time, and that's my point earlier about you're constantly changing the lines because well-intentioned things work or don't work, or somebody comes up with a better idea. You find out that something that seemed to be wonderful is no longer wonderful. And so we got to keep changing these things.
There's a gentleman in the back that's had his hand up for some time, and I want to make sure. No, that's okay. You go ahead. The person has a microphone, but I want to get to him before we wrap up here. Yeah.
Well, I hope this might be a quick answer. It's about health care insurance. I wonder what your opinions are about whether there's a social benefit to having a for-profit, private health insurance industry between patients and providers.
But say a little more, I'm not sure I understood the question.
Okay, is there a social benefit for the nation, for our whole society in having a private, for-profit health insurance industry? Do we need a health insurance industry since our health outcomes are not particularly good in this country, and yet we spend more than a lot of other countries on health care? And that's not, I don't think, all fault of the health insurance industry, but I wonder whether you think, as experts in this area, that the health insurance industry, the private health insurance industry, is in fact a social benefit overall.
Should exist at all.
Yeah, so I'm not quite sure whether the question is asking about insurance or health care.
Well, insurance.
I mean, are they connected?
We have private making health insurance companies.
So I guess all I'm saying, do you think a single payer system is a better way to deliver health care, or do you think that we need a for-profit private health insurance industry in the mix?
I see. Well, you know, I just say personally, I'm a single payer person, but I don't think that means that this system can't work better, but it's got to be regulated, and it's got to be regulated in a way that looks to what is the benefit that's being provided, and you know, what is it under the new, I think I've got the figure right, that under the new national health care, the insurers have to provide insurance from on at least use at least 80 cents of each dollar to provide insurance. What's the other 20 going for? I mean, I think that's not the right number, so that it can be better managed. I don't know that it can't work. It's certainly not working.
I would prefer to have a single payer system, but don't think it would solve the problem that you stated at the beginning, which is that we spend too high a percentage of GNP on healthcare and get no better results. We spend about 17% of GNP. Other of the leading industrialized countries spend about 10%, and our statistics are no better than theirs. That's a little worse, yeah. That's 7%. Is about $1 trillion a year, and that's a pretty substantial number. That is more than we have spent on the Iraq War, but we spend it every year on that additional health insurance or health care cost. But I don't think it would get solved by having a single payer system, even though I'd probably support one.
I mean, there are multi-payer systems. Germany's one. They have 150 to 200 non-profit insurers. Switzerland's got over 100 profit-making insurers. But pretty consistently across the board, their costs are about half of ours on a per capita basis. How come? Because they regulate costs, folks, regardless of what kind of an insurer you have. Now, you may not like that. They don't like it. I mean, maybe our insurance companies wouldn't like that. But the fact of the matter is, it doesn't make, without exception, regardless of the form of insurance, profit-making, non-profit, multi-payer, single-payer, they regulate costs. And at least so far, we don't do that. Yeah.
My name is Richard Giordano.
Welcome. Nice to have you back.
I want to thank both commissioners for pushing the discussion about the role of government and how much is social risk or private risk and how much is social profit or private profit. I think I would like to push in two directions you both brought up. Commissioner Brunson was saying how we have socialized the risk and privatized the profit. I think it was Commissioner Stone who was saying how somehow the conversation, the overall framing of the issue has changed to such an extent. And I would like to point out, on some level, the stock market is almost a fraud at this point. Individual people are encouraged to invest and look for companies that look like good businesses and put their money in. And in the meanwhile, transactions of the tens of trillions of dollars are happening through through computer-generated programs where they buy and sell, buy and sell, buy and sell, buy and sell by the second to generate some kind of profit that's not anything to do with long-term investment like the Buffett piece. So I think somehow we have to push that discussion and keep bringing it up. I mean, the whole business of credit default swaps is not investing, it's gambling, it's madness. I mean, these people were buying and selling, hoping that companies were really not going out of business, but making profits on the back and forth, Somehow we have to elevate that discussion and bring it out so that we can begin to say, well, if this is not working, how do we change it? And we have to, freedom of the press belongs to those who own the press. We have to get at this stuff and push it more into the open so that we can at least have the argument and the disagreement about how to deal with it. Because at this point, we've lost both. We're not regulating it, and we've lost the discussion.
Let me just take a little tiny piece of that. The issue of the privatizing the profit and socializing the risk was not a policy decision. Somebody didn't sit down and say that's what we're going to do, but it is a result of what has happened. And I think there is a conversation now and a recognition that this has happened, and people are beginning to realize that this is not the way you want to socialize risk. And there is a conversation about how to readjust that. I don't know if you have any more comments.
Well, the specific examples that you gave, we know how to deal with. It's just that it's not the view of policymakers today. It's not the administration's view. It's not the Congress's view. And so while I think you and I would probably agree that you don't want this tremendous volume of 1 second purchases and sales that go on in market, a transactions tax would deal with that. But we don't have a transactions tax. If you don't want banks to have the power that they have politically, it could be smaller, but we're not breaking them up. If you don't want to have the sort of overhang of derivatives that can bring down a whole economy or a whole continent's economy, we don't have to allow highly leveraged derivative transactions. We didn't used to. And so all of these things have solutions, but at the moment, it is not part of either the administration or the Congress's point of view. So unless somebody can lead, teach, bring other people along, it isn't going to happen.
On that note, I think this has been a very